I'm Edo Kienhuis and a member of the International Auditing and Assurance Standards Board, the IAASB. I was also the chair of the Going Concern Task Force, and I have the pleasure of talking you through the key changes the IAASB has made to ISA 570 revised 2024 Going Concern. This revised standard was approved by the IAASB in December 2024 and published in April 2025. The project to revise the IAASB's Going Concern standard focused on targeted revisions rather than a comprehensive revision of the standard. Having said that, the revisions are still substantial and all the more reason for this video. The drivers for these revisions stem from corporate failures worldwide, for example, Carillion, which have raised questions about auditors' responsibilities. In addition, global challenges such as war, pandemics, as well as a more volatile economic environment have intensified the focus on going concern. Consequently, stakeholders have heightened expectations for a more robust standard and greater transparency in the auditor's work related to going concern. The IAASB has now responded by enhancing and clarifying its auditing standard on going concern to ensure it remains fit for purpose in today's evolving macroeconomic and geopolitical landscape. The project objectives and aim of the enhancements and clarifications was to promote consistent practice and behavior and facilitate effective responses to identified risks of material misstatement related to going concern. To strengthen the auditor's evaluation of management's assessment of going concern, including reinforcing the importance throughout the audit of the appropriate exercise of professional skepticism, and to enhance transparency with respect to the auditor's responsibilities and work related to going concern, including strengthening communications and reporting requirements. The revised standard addresses the auditor's responsibilities in an audit of financial statements related to going concern and the implications for the auditor's report. It applies to all audits of financial statements, irrespective of their type, size, or complexity. For audits of financial statements of listed entities, additional auditor reporting requirements apply in certain circumstances. So let's discuss some of the key changes that were made. First of all, the standard has a new definition for material uncertainty related to going concern, which also explains the phrase may cause significant doubt. By defining a material uncertainty related to going concern, the IAASB aims to promote consistency in application across jurisdictions and support understanding of this core concept that applies to both auditors and preparers. A material uncertainty related to going concern is defined as an uncertainty related to events or conditions that individually or collectively may cause significant doubt on the entity's ability to continue as a going concern. The standard also explains the phrase may cause significant doubt. This is used to indicate circumstances where the magnitude of the potential impact and likelihood of occurrence of the identified events or conditions are such that unless management's plan for future actions mitigate their effects, the entity may be unable to realize its assets and discharge its liabilities in the normal course of business and continue its operations for the foreseeable future. I previously touched upon strengthening the auditor's work effort. There are 4 areas where this is clearly evident. In risk assessment, in the evaluation of management's assessment of going concern, in the time period that needs to be considered in management's assessment, and in the evaluation of management's plans for future actions when events and conditions have been identified that may cause significant doubt. Let's dig a little deeper into the risk assessment and related procedures. In respect of the risk assessment, the approach of the revised standard is that it provides a going concern lens in applying the requirements of ISO 315, identifying and assessing the risk of material misstatement. As such, the revised going concern standard articulates specific requirements regarding obtaining an understanding of the entity, its environment, the applicable financial reporting framework, and the entity's system of internal control. For example, an understanding needs to be obtained of industry conditions, including the competitive environment, technological developments, and other external factors affecting the entity's financing. But for example, also the entity's risk assessment process to identify, assess, and address business risks related to event or conditions that may cause significant doubt. The revised standard requires the auditor to determine whether the audit evidence obtained from risk assessment procedures and related activities indicates the existence of events and conditions that may cause significant doubt, which management has not previously identified or disclosed to the auditor. If the auditor identifies such events or conditions which management had failed to identify or disclose to the auditor, this may constitute a deficiency in internal control. In such cases, the auditor then also needs to think about whether management had intentionally failed to identify or disclose to the auditor such events or conditions, as this may raise doubts about their integrity and honesty, such as when the auditor suspects an intention to mislead. ISA 240, the auditor's responsibilities relating to fraud in an audit of financial statements, will then come into play. The revised standard also specifically requires the auditor to remain alert throughout the audit for information about events or conditions. Such information may be obtained through external information sources such as analyst reports, information about short selling of shares, or economic or earning forecast, but also, for example, from other engagements performed for the entity, or the auditor's consideration of other information in accordance with ISA 720. The standard emphasizes that events or conditions are identified on a gross basis, i.e., before consideration of mitigating factors included in management's plans for future actions. The IAASB believes that management's assessment of going concern is fundamental to support management's assertion that it is appropriate to prepare the financial statements using the going concern basis of accounting. Consequently, the standard requires the auditor to evaluate management's assessment and the significant judgments on which it is based. Note that this is irrespective of whether events or conditions are identified. This evaluation shall include evaluating the method, significant assumptions, and data used by management in assessing the entity's ability to continue as a going concern. In respect of the method, the auditor needs to evaluate whether the method selected is appropriate in the context of the applicable financial reporting framework, and if the calculations applied are in accordance with this method and are mathematically accurate. In evaluating whether the model is appropriate, the auditor may consider the alignment with the complexity and size of the entity, management's rationale for the selected method, and whether changes from or within the method are appropriate in light of new circumstances or new information. As to the significant assumptions, the auditor's procedures shall address whether these are appropriate in the context of the applicable financial reporting framework, consistent with each other and with related assumptions used in other areas of the business activities. So, for example, the auditor may consider whether the assumptions used in the going concern assessment are consistent with those used in, for example, business prospects, assumptions in strategy documents, and assumptions used in making accounting estimates, such as impairment assessments. But also whether the assumptions used by management in the prior period were reasonable, for example, by comparing the prior year assumptions to the actual outcomes in the current year. Regarding the data, the audit procedures shall address whether the data is appropriate in the context of the applicable financial reporting framework and relevant and reliable. Scalability and proportionality is acknowledged by the revised standard in that the nature and extent of the auditor's procedures may vary. These would depend on the method, significant assumptions, and data used by management to assess the entity's ability as a going concern, but also the nature and circumstances of events and conditions that may cast significant doubt on the entity's ability to continue as a going concern, and the results of the auditor's risk assessment procedures. I mentioned the fundamental importance of management's assessment, and as such, it is important that management makes an appropriate assessment. It is not the auditor's responsibility to rectify a lack of analysis or assessment by management. If management is unwilling to make its assessment, the auditor is required to consider the implications for the audit. The application material clarifies that the auditor may consider management's lack of assessment as a limitation on the audit evidence obtained. Consequently, in accordance with ISA 705 revised, when the possible effects on the financial statements of the inability to obtain sufficient appropriate audit evidence are pervasive, the auditor would have to disclaim an opinion. But the standard also recognizes that in certain circumstances, a less extensive analysis by management to support its assessment may be appropriate. For example, when the entity has profitable operations and there are no liquidity concerns, and the entity's risk assessment process has not identified events or conditions that may cause significant doubt, the method, assumptions, and data used by management to make its assessments may be less extensive. However, in other situations when, in the auditor's professional judgment, management has not performed an appropriate assessment based on the nature and circumstances of the entity, this may be an indicator of a deficiency in internal control in accordance with ISA 256. The revised standard extends the commencement date of the 12-month period of management's assessment of going concern that is used as the basis for the auditor's evaluation. The time period remains 12 months, but the commencement date is now the date of the approval of the financial statements rather than the date of the financial statements. This is consistent with IAS 1, which specifies a minimum period and is not a cap. The IAASB acknowledges that there were mixed views to this proposed extension in the exposure draft, but we have decided that there was a sufficient basis to retain the proposal with some refinement, in light of a general recognition from all stakeholder groups for the public interest value of going concern assessments to include more current and relevant information for user decision-making. But also evolving practice where a different commencement date of the period of the auditor's evaluation is already applied, even though it was not required. And also, some jurisdictions have already adopted a different commencement date of the period of the auditor's evaluation in their national equivalent auditing standards. So given the change in the commencement date of the 12-month period of management's assessment of going concern, the auditor may run in situations where management's assessment of the entity's ability to continue as a going concern covers less than 12 months from the date of approval of the financial statements. For example, such an assessment would only cover 12 months from the year-end reporting date. In such cases, the auditor shall request management to extend its assessment period to at least 12 months from the date of approval of the financial statements. If management is unwilling to extend their assessment, the auditor needs to first discuss the situation with management and, where appropriate, those charged with governance. During this discussion, management or those charged with governance may be able to provide additional information to support the appropriateness of management use of the going concern basis of accounting in the preparation of the financial statements. For example, this may be the case when the entity has profitable operations, it has no liquidity concerns, and management or those charged with governance have not identified any events or conditions that may cast significant doubt beyond the period of assessment they have chosen. I do note that this would be the exception to the rule, and consequently, the auditor would need to document the professional judgment applied. However, if following the aforementioned discussion, the auditor remains of the view that it is necessary for management to extend its assessment, and management remains unwilling to do so, the auditor shall determine the implications for the audit. As was the case when management did not prepare an assessment at all, the auditor may consider management lack of assessment as a limitation on the audit evidence obtained, which again could lead to the auditor disclaiming the opinion. So I have covered risk assessment and related procedures, management going concern assessment, and the work effort by the auditor in respect of that assessment. The outcome of all of this is the identification of events or conditions that may cast significant doubt on the entity's ability as a going concern. If such events and conditions have been identified, the revised standard is now explicit that the auditor is required to evaluate management's plan for future actions in mitigating the effects of those events and conditions. This evaluation includes whether the outcome of these plans is likely to be sufficient to mitigate the effects of the identified events or conditions. Also, whether management's plans are feasible in the circumstances, and whether management has both the intent and ability to carry out the specific courses of action. It is not uncommon that management's plan for future actions comprises financial support by third parties or related parties, including the entity's owner-manager. The revised standard is now much more explicit that in these cases, audit evidence needs to be obtained about the intent and ability of those parties to maintain or provide the necessary financial support. So, audit evidence needs to be obtained whether such party can and will provide the financial support when needed. At this junction, after having done this, the auditor is required to evaluate whether sufficient appropriate audit evidence has been obtained regarding and shall conclude on the appropriateness of management use of the going concern basis of accounting in the preparation of the financial statements. The auditor shall also, based on the audit evidence obtained, conclude whether, in the auditor's professional judgment, a material uncertainty exists related to events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. I'm specifically pointing this out as both conclusions will feature in the auditor's report as per this standard. This will be our next topic. One of the project objectives for the revision of the going concern standard was to enhance transparency with respect to the auditor's responsibilities and work related to going concern where appropriate, including strengthening communications and reporting requirements. Now let's focus on the auditor's report. The revised standard introduces an enhanced auditor reporting model for going concern. This includes a new and separate going concern section in the auditor's report. When there's no material uncertainty, this will be under the heading of going concern. But when there is a material uncertainty, the heading of this section will be material uncertainty related to going concern. In both these sections, the auditor has to make explicit statements about the auditor's conclusions. And for listed entities, when significant judgments are made by management in concluding that there's no material uncertainty, sometimes called close calls, the auditor is required to provide further transparency. Further transparency is also required for listed entities when there is a material uncertainty. You may have noticed that I've used the term listed entities in this video, even though in June 2025 at its board meeting, the IAASB approved the PI Track 2 narrow scope amendments. And this will mean that the term listed entities will be replaced by publicly traded entities, PTEs. Given that both the revised going concern standard as well as the PI Track 2 narrow scope amendments will have the same effective date, I have and will continue to use listed entities throughout this video to be consistent with the approved revised going concern standard. But I do note that this term will be replaced by PTE in due course. Let's dive a little deeper into the implications to the auditor's report. This slide provides an overview of the reporting model in accordance with the revised standard when the auditor's opinion is not modified in relation to going concern. Not modified in this context means that the auditor's opinion is not qualified or adverse in respect of the going concern basis of accounting or the going concern disclosures. This framework illustrates the content of the going concern section or the material uncertainty related to going concern section side by side. For all entities, in both scenarios, the auditor will need to explicitly state that they concluded that management use of the going concern basis of accounting is appropriate. When no material uncertainty exists, the auditor needs to state, indeed, that no material uncertainty has been identified. However, when a material uncertainty does exist, the auditor explicitly states that a material uncertainty exists, as well as that the auditor's opinion is not modified in respect of the material uncertainty. Next to the required statements, further context is to be provided. For example, to emphasize that the explicit statements are not an opinion on a discrete matter in the audit, nor that these are a guarantee as to the entity's ability to continue as a going concern. For listed entities, further transparency will need to be provided by the auditor, analogous to a key audit matter. When no material uncertainty exists, such transparency is required when management had to make significant judgments in concluding that there is no material uncertainty. Or in other words, it was a close call. When this is the case, a description needs to be included of how the auditor evaluated management's assessment. When a material uncertainty does exist, for listed entities, the auditor provides further transparency by describing how the auditor has evaluated management's assessment of the entity's ability to continue as a going concern. Again, all of this is required when the auditor's opinion is not modified in relation to going concern. The revised standard has illustrative examples for a qualified and adverse opinion when the auditor has concluded that a material uncertainty exists and the disclosures are inadequate that there is a material uncertainty, or such disclosures are not included at all. I finally wanted to note that when a disclaimer of opinion is issued, also when this is not as a result of matters related to going concern, the separate section on going concern or material uncertainty related to going concern should not be included in the auditor's report, unless this is required by law or regulation. The revised standard has also strengthened and clarified the requirements to enhance timely, two-way communications with those charged with governance throughout the audit engagement. And it includes the requirement to communicate with appropriate authorities, for example, a supervisory authority. As such, the revised standard requires the auditor to determine whether law, regulation, or relevant ethical requirements establish responsibilities or rights under which reporting to an appropriate authority outside the entity may be appropriate in the circumstances. Up to this point in the video, I've covered enhanced clarity for the concepts and terms, such as material uncertainty related to going concern and significant doubt. I explained the strengthened auditor's work effort in relation to the evaluation of management's assessment of going concern, as well as management's plan for future actions, if applicable. And I covered the enhanced transparency with respect to the auditor's responsibility and work related to going concern. There are some additional changes in the revised standard worthwhile pointing out. These are: there's an increased emphasis on the importance of professional skepticism and consideration of the risk of management bias. For example, in the risk assessment, evaluation of management's assertion of going concern, and the evaluation of management plans for future actions. There are also strengthened written representation requirements, and next to the application material with scalability guidance for small or less complex entities throughout, the revised standard also provides specific scalability considerations for public sector entities. Having covered the significant changes in the revised going concern standard, let's now have a look at the implementation resources and tools that the IAASB has made available next to this video. These can all be found on the IAASB website and comprise of the basis for conclusion, the final pronouncement of the revised standard, a fact sheet, as well as a frequently asked questions about reporting going concern matters in the auditor's report. Finally, a few words on the effective date. The revised standard becomes effective for audits of financial statements for periods beginning on or after December 15, 2026. So it is to be applied on 2027 audits and onwards. Early adoption is permitted, but if early adoption is contemplated, the collective changes arising from the going concern, fraud, and listed entity and PI projects should preferably be early adopted as a package rather than on a piecemeal basis. So, this brings us to the end of this video in respect of the revised going concern standard. I hope you found it useful, and I wish you the very best with the implementation of this revised standard. Thank you very much for your attention.